What's the problem? Information gathering increases confidence, but not accuracy. This is what I was talking about to begin with, where if you dive way too deep into a company and you research a company, sometimes that can increase your information gathering. You have more info about the company, but not your accuracy. So you're not more likely to be correct about that company. They also highlight, this is less relevant to us, exposure to sales pitches. I guess that's relevant because you can get exposed to a sales pitch of a company, misdirected intellectual effort and intellectual dishonesty. Now, this is a part that I think is worth paying attention to. The outside view. Overconfidence can have profound consequences, inflating investors' valuation of their investments. So if you're overconfident in your own investments, if you've done so much research on them that you feel like you know everything inside and out of a company to the point where you're just very confident on this investment, it can lead you to having an inflated valuation of your company. And you have to ask yourself that. Have I done so much research on this that I just feel like it has to be worth more than what it actually is? Have I done so much analysis on Netflix and Disney that I think these companies are worth more than they are? Have I done so much analysis on Apple that I think that Apple's worth more than what it actually is? Those are questions you have to ask yourself. Those are holdings that I'm bullish on. I consider those questions with myself. Think about the companies that you're bullish on, that you've done research on, and ask yourself if you might have done so much research on it that you think you might be attributing too much to this company, too much value to it. They say leading physicians, this is something that's not just happening in the investment world. They say leading physicians to gravitate too quickly to a diagnosis and making people intolerant of dissenting views. So if I ever get to the point where I don't even want to listen to someone's argument against a company that I'm invested in, that's not a point that you should be at. And that is where a lot of people get with good companies. They've done so much research on Tesla. They know everything, and you haven't done as much research, and you haven't done as much research. I know more about you than Tesla, on Tesla, right? So even if you come with a counter argument about Tesla, I don't even want to hear it because I know more about Tesla than you. I don't even want to hear your argument. You don't know anything about it. I've done more research, and your concerns about the valuation, your concerns about the competition, I've done the research. They can't compete. I know more. That's the attitude a lot of people have, especially with cult-like companies, right? Everybody, I think, that does investments and they're excited about a company you're invested in, I think it's a normal human behavior to do this. And obviously, again, it's not just investing. They have examples with physicians that are too quick to diagnose somebody with something that they probably studied and learned about. Also, it makes you intolerant of any type of dissenting views, so you're not open to criticism. So I know that I know when somebody is completely incapable of hearing criticisms of their investment, that they're not a great investor. And I'm just being totally blunt here. If I even raise a question about a different company or a different investment, if I raise any type of surface level criticism like, hey, I think the valuation might be a little bit off here or whatnot, and somebody just attacks me for it, like they can't stand that somebody was slightly questioning their investment, I know right off the bat they're not a good investor. Because they are intolerant of any dissenting views. They're incapable of looking at the other side and even observing someone else's opinion. So that's something that they say is overconfidence can have profound consequences, inflating investors' valuation of their own investments. Numerous studies, right? This isn't something that this hedge fund is just saying. They're saying numerous studies suggest that confidence and accuracy are not highly related. You can be extremely confident about your investment. That doesn't make you right. College football experts were asked to predict game outcomes, organizational behavior, and human decision processes. Professional horse handicappers predicting horse races, Paul Slovic. In subsequent rounds of the game, the experts were given additional information and asked to rank their confidence. The additional information did not improve the accuracy of their predictions, but did increase their confidence of their bets. So although they became confident, they weren't any more accurate than anybody else guessing. The problem with this is it relates to investing is that the extra confidence causes us to increase the size of our bets without the corresponding increase in our capacity to predict the outcomes, causing us to lose money. Meaning, you might become so confident in investment because you spent the time, you've done the due diligence, you've done the work, that you put more and more money into this investment, and the outcome might not be what you predicted, and you end up losing a lot of money, an outsized amount of money, because you put such a heavy bet on it. I have an example of somebody that did this that I'm going to show in a minute. In fact, I'll show that right now because it plugs in so good. I want to read this part again just to emphasize it. The problem with this as it relates to investing is that the extra confidence from studying an investment, from doing due diligence on it like crazy, can cause you to increase your size of your bets without the corresponding increase in the capacity to predict the outcome, causing you to lose a lot of money. Let me go to the example here. I'm not trying to he's actually acknowledged the mistakes he's made, but this is somebody I want to highlight on Twitter. His name's Richard Chu. He has 63,000 followers on Twitter. So he has a big group following him. That's a huge following for financial Twitter, right? I know I have like 200,000 and 210,000 on YouTube, but this is a lot for Twitter. This person, just to give some background, did incredibly in-depth research on the healthcare disruptive technology industry. He, 7 months ago, invested 40% of his portfolio into Teladoc. Okay? And he knew everything about Teladoc. He knew the managers, the executive team on he knew their first and last name of every executive. He knew all the deals that they're doing. He thought that there's going to be synergy with Teladoc and other things. He knew all the potential deals, and he knew everything about the company. Richard became extraordinarily confident with his investment, where he was willing to put 40% of his portfolio into one small company called Teladoc, right? And for a certain time, it was going up. It was an ARK Invest, Cathie Wood type of thing. It was going up. And then more recently, things have changed. Now, let me find the post here. He talks about his experience and what happened. He has 40% of his money in Teladoc. And then let me go to the Teladoc. Let's take a look at the performance here. This is over the past year. This is when he was buying it. He thought that things were changing for the company, and he was buying it, all throughout here. And then Teladoc from its highs has dropped 50%. So this is a company that he knew everything about. He knew the ins and outs of this company. He knew all the research on it. He did all the work on it, and then things didn't work out. This is his post that he put after realizing his mistake and reassessing his investment decisions. He says, "Many of my mistakes have been being too early to a story. Although you can earn much higher returns by seeing potential before the market does and being right, the vast majority of great stories don't turn out to be successful investments. Proof of execution is critical." He says, now this is much easier said than done, especially when I'm investing in young companies that are still early in the stages of market adoption. Where's the sweet spot? Where is there enough proof that your thesis is achievable without it being a consensus to fully priced in? And do you have enough margin of safety where you don't lose too much even if your thesis doesn't play out as you hoped? Of course, the earlier you are, the harder it is to get it right because the distribution of possible outcomes is wider. He addresses Teladoc and how wrong he was on this bet and how much money. Well, he doesn't say the total amount he lost, but he lost a lot of money with Teladoc. While Teladoc and LVGO both had a good track record, my thesis relied on them outperforming cross-selling synergy targets and the successful integration of Levingo or whatever it is, both of which had not occurred. They had all the ingredients, but I needed to believe in their ability to execute. I had read a ton of materials that led me to envision what the future of healthcare should be. It was clear that Jason, Glenn, and Hemant shared my vision from past interviews and earnings calls where they made the right acquisitions to get there, so I felt comfortable projecting. While they may still realize my original vision, I'm definitely hoping they do. Recent data made it clear that I am underestimating the execution risk required to get there. Other more spec ideas, like these two, also had the right ingredients but needed to show execution. Investing is all about thinking in bets. My goal is to find those investments that have a high probability of working out based on the data I have today, but data changes. We can't control what happens, but we can control how we react to it. I found that successful investments tend to be the ones where I've had an easy to explain thesis tracked by a few key metrics that tell me if the thesis is playing out, and I didn't overpay relative to what was likely to happen. His last tweet here on this subject is absolutely key. He says, I found out that my most successful investments, noting that he's lost a ton of money on Teladoc, right? His most successful investments have been easy to explain. Like Peter Lynch says, they have to be easy to explain investments, tracked by a few key factors that tell me if my thesis is playing out, and I don't overpay relative to the opportunity. Now, the reason that I highlight Richard here is because he's an example of somebody that I think falls under this type of trap of keep making investing more complicated than it is. If we look at investing through simple terms, investing in companies, looking at a few metrics to gauge their valuation, and then investing in companies that you think have a good likelihood of compounding, of building and growing over the next decade, I think you'll have much better results than doing what Richard did. And obviously going so in depth to one company that you know the ins and outs of it, that you aren't even thinking about anything else. You're not even considering anything else. And you have a super inflated estimation of what your companies are worth. So he definitely falls under this category of being overconfident in his investment, and that didn't increase his accuracy. Teladoc has not worked out so far. Now, I do need to highlight, let me log into M1 Finance here, because I need to point this out. He's not the only one to invest in Teladoc. Teladoc is a popular company, right? If I go to my portfolio, I have Teladoc, I still hold it. The difference is not putting 40% of your portfolio on it. When I lost 50% in Teladoc, I lost $576. Teladoc was a small portion of my portfolio. And I think that that's why you size your bets accordingly. You make it so that your list of holdings that you're invested in is a little bit more flat than making it so heavily weighted towards a couple of companies. And if you do weight it towards those couple companies, you have to be right. You have to be right. There's no room for error. There's no room for getting it wrong. You have to have an incredibly good margin of safety, very low likelihood of losing money. Teladoc, I do not think, fell in that category. I think that Teladoc was an incredibly risky holding for him to have as 40% of his portfolio. So it's okay to have companies not work out the way that you want them to, as long as you're sizing the bets appropriately, making it so that your portfolio at the end of the day has a lot of different bets. And if you're buying all these companies for decent valuations, you'll make money in the end. But I just wanted to point that out. I do own Teladoc as well. I'm not blaming Richard, but portfolio diversification and the weighting is very important. Now, this goes on further, highlighting